Good morning, everyone, and I wanted to welcome everybody to our presentation this morning on your rate category, your risk category, and your rate renewal. This is a very hot topic right now. This is that time of the year, as we all know. We've had a lot of good discussions, a lot of good questions after our two member group meetings that we had, the one in Oklahoma City, and then the web-based presentation that we did for our Texas banks. We've got quite a few bankers that are on this today. We're pretty close to 60, and that's a mix of Oklahoma banks and Texas banks. But like I said, after the user group meetings, we did have a lot of questions, and I think as people take more ownership in their plan, like we want them to do, like we want you and your employees to do, that has prompted more questions about, well, okay, so now that I'm an owner, I need to really understand how are we being evaluated, if you will, and as far as how the cost is shared among the member banks. And so we kind of preempted a previously scheduled webinar over compliance, healthcare reform compliance, which honestly, it was kind of refreshing to me. We've been talking about healthcare reform for so long. Being able to take a break and move into something else was kind of a good thing. But that is what we're going to talk about, is really the methodology that Advantage uses to determine rates and also an individual bank's risk category. The agenda, first item, and I might want to interject right now at this point. When I say risk category, what we're trying to transition not only ourselves but also our member banks away from is not being the utmost and slick marketeers out there. Risk categories have always been known as buckets, over the last 3 or 4 years. We're trying to transition away from bucket into the term risk category. It is more explanatory as far as what that actually means. And so when you hear me say risk category, think bucket, but hopefully by the end of this presentation, we won't be calling them buckets anymore. We'll be calling them risk categories. But again, our agenda is going to be first, how are the rate increases, how are they calculated? And it's really kind of a multi-step process, and we'll go through that. Also, what are your risk categories, what your risk category means to your bank, what factors are used to determine risk categories, and then a quick FAQ in regards to rate categories of what can you do to change what your bank pays. And I know that's what the CEOs that are on the call, or if we have HR professionals that are on the call, that's why you're on this. So we'll spend a little time on that. A little bit of background for those banks that have been with us for years and years and years know that for several decades we use what is known as a composite rating model, which simply all the banks, regardless of their size, their overall health, they all paid the same rate. That was kind of the old way of doing things. The trustees and the administrator of my company and the banker trustees that run the program felt like that needed to evolve a little bit. Boy, we were all in agreement with that, and it needed to evolve to a point where the banks that are less risky should be rewarded for their efforts in being a less risky bank, and we also need to provide an incentive to help the banks that do have more risk within their bank population. We need to provide an incentive for them to make better decisions. And when we talk about wellness or we talk about buying better, we wanted to provide an incentive for an individual bank to become a less risky bank. So we employed Milliman Consulting to help us do that. Milliman has been working with Advantage Health Plans for several years to help us with our reserve calculations for our member banks, also to make sure that we're in compliance with the various insurance commissioners that we do business with. But the underwriting model that we did adopt, that was kind of another offering that they have, is actually based upon the Milliman small group underwriting model that they have developed in the industry, who uses this model besides Advantage Health Plans would be employee leasing programs, or some of our banks know those as PEOs, like the Administaffs of the world, the Trinets of the world. They use this type of an underwriting model. Also other association plans like Advantage Health Plans, and also just small group health insurance companies all purchase this model that we're going to describe that we use. They purchase this from Milliman. We have adapted it quite a bit. It still is basically the original model, but I'll point out a few areas where the trustees have tweaked it to make it make more sense, we feel, to the Oklahoma banks and the Texas banks that are members of Advantage. The overall goal, though, was to make sure that it was fair, it was equitable, and most importantly, we need to make sure that we're collecting enough dollars to provide the benefits that our bankers expect us to be able to provide in a safe and a conservatively run fashion. Again, I said that it was a two-step process that Milliman uses. The first step is Milliman will recommend the rate increase that is needed for Advantage Health Plans as a whole. Really, you need to kind of think that Milliman does the exact same process today, since we started using risk categories, as they did 7-8 years ago when we all had a composite rate. They still look at the trust, the inflow of dollars that come from the banks in the form of premium, or what we call contributions. They look at the dollars that come in, and they look at the dollars that go out. And as we know, far majority of those dollars that go out are used to pay our member banks' health insurance claims, dental claims, prescription claims, etc. But there's also there's some other charges that go towards stop loss reinsurance. They go to PPO access. They go to the Kempton Group for the administrative duties behind Advantage. And there's also something that we mentioned at our user group meeting that they also take into consideration, and that is, what does medical inflation look like it's going to be for next year? And what do the reserves need to be for Advantage? Even though it's all Advantage Health Plan's money, if Milliman feels that medical inflation is going to be on the increase next year, they may actually recommend to the trustees that we need to increase the reserve allocation, and that is also an additional pressure on the overall rate increase for Advantage Health Plans as a whole. If you've spoken with myself or Vicki Toombs or David Weaver or Jeff McQueen, they may have referred to this as the lake level increase, and that's just a kind of a down-home way of describing that when Milliman recommends that we need to have a 5% or a 7% increase, that just means the total contributions within the trust need to rise by whatever that overall contribution level needs to be. Then that's really step one in the reserve process, and that's something that the trustees will actually be voting on a week from this Friday. I believe that's the 26th of October. And they're going to be looking at all of the data and Milliman's recommendation to determine what that rate increase level will be that is overall trust-wide. Once Milliman makes that recommendation, the trustees, like I said on the last bullet there, the trustees will consider Milliman's recommendation. They are free they can vote to accept it, they can vote to alter that recommendation, or flat out reject that recommendation. I've never seen them reject the recommendation, but I have seen them sometimes will, just based on either information that they've received from Kempton, my office as the administrator, or from just gut feelings, intuition, they will either decide to add a couple of points to that rate increase, or maybe if they feel more optimistic, they may shave a couple of points off of that overall Milliman recommendation. But once that is completed, and that will be done by the end of business a week from this Friday, then we move into step two. Step two of the process is where our individual banks become much more involved, and this is what you're really wanting to know about. Step two is where, once the step one is complete, step two is, how do we determine where an individual bank's risk category fits. So is your individual bank about the same risk as it was last year? Is it a little bit more risky this year, or is it less risky than it was last year? All of those factors are taken into account to determine what your bank's individual rate increase will be. And also, as an FYI, a lot of our banks ask, what if I'm, back in the old days when you were a C2 bucket, or which we would call now a +1 rate category. If you're a +1 rate category and your overall risk doesn't change, it stays exactly the same next year, what rate increase do I get? You get the overall trust level increase. So any bank that really has kind of a consistent year in, year out, no change, then you will just get the regular overall rate increase that is done by the trust. Risk factors do determine your overall risk category or your bucket movement. We're only some of the constraints that the trustees put into Milliman's model, which I said, they adopted the Milliman's model, but they made a few tweaks. These next two items on these two bullets here are some of the tweaks that they made. I think they're great adjustments. The very first one is only one rate category can a bank move per year. Milliman, when they evaluate an individual bank, if all of a sudden we've got a tremendous increase in risk in an individual bank because of diagnoses or whatever, Milliman may indicate that your bank needs to move 3 rate categories in 1 year. The trustees felt that was just really not fair. We used to be where we were all for one for all, and there was protection of being part of the group. So limiting Milliman's model to where even if a bank is indicated to move 3 buckets, 4 buckets in 1 year, the trustees have put in a policy where no one particular bank can move to a more expensive rate category or a less expensive rate category. You can't move more than 1 category a year. Some of the other things that they did, which was instituted last year, and I'm pretty sure it'll be carried over this year, is to further quell some of the volatility that we see out there. They did really kind of a 2-for-1 arrangement where Milliman actually will have to recommend that your bank shift at least 2 rate categories or more before we will allow you to move 1 rate category. So they're really, as we were going over this presentation, the best analogy that I could come up with is whether it's to the good or to the bad from a risk standpoint. We want, before a bank is going to shift, we want there to be a consistent and continual pressure in one direction or another. So if your bank is consistently doing better year after year after year, we want to see your bank move into a better risk category. Likewise, if your bank is consistently year after year going the wrong direction and is getting more risky, we want to see that consistent pressure to the more risky side before we're going to move your group. But there is going to be volatility, and 1 year you're great, 1 year you're not so great. We want to try to squash that just random volatility out of the trust. And we feel like that is one of the valuable things of being a self-insured plan that our member banks are part of. Again, as an example, we wrote out, for example, if Milliman indicates the bank should move from a 0 rate category to a +1, the bank will stay at that 0 risk category or no movement. However, if Milliman indicates that the bank should move from a 0 to a +2, then the bank will move to a +1. So hope that makes sense. If not, we'll catch you in the questions later. Okay, so that's step 2. The step 3 is simply combining step 1 and step 2. It is the trust level increase plus whatever risk category change, if any, that your bank experienced equals your total rate adjustment for your bank. So this is probably important for everybody to understand is since we are literally all still in this together. And in other words, all the contributions that come in are used explicitly for this plan. It's nonprofit. There's not, the dollars stay within the plan. That if the trust as a whole, all the member banks have a good year overall, then that trust level increase is smaller, and that benefits everybody. So in one respect, we are all pulling the wagon in the same direction, which is a great thing. So there is an overriding overall incentive to be judicious utilizers of the plan. And we've talked long and hard about the Go for Green strategies and everything, but that really does, it does matter, regardless of your individual bank's situation. It does matter to protect the trust because it's your dollars and it can lower that overall trust level increase. And then, of course, your shift in the rate category and your risk category also has an effect. For example, if the trust increase is a 12, and no, I'm not saying it's 12. That was just a number we threw out there. But if it is a 12 and the bank moves up a risk category, then the difference in the cost between those risk categories will be added to the overall trust level increase of 12. Likewise, if your bank, and some banks have experienced both of these scenarios. If the bank is going down a risk category or going to a less risky, a better risk category, then the difference between the risk categories will be subtracted from the 12%. So again, if we had a 12, but your bank ends up getting a 3 or a 6, then you'll know that your bank actually moved to a better risk category, which was used as a credit against that overall trust level increase of 12. Doing these webinars, folks, is challenging because I don't know whether I've lost everybody in the room or everybody's following along and nodding knowingly, but I'm going to continue and we'll catch up with questions at the end. Okay. Risk categories. What are risk categories? We'll break this down a little bit. For those that have been around for a while, when we first did the risk categories, remember they were buckets and they started off with that middle bucket or middle risk category was a C, and we kind of used the old report card methodology. We are still using the same categories, but we have relabeled them. Hopefully it'll make a little bit more sense to our banks. We hope. We are obviously open to suggestions, but everything is indexed to the average within Advantage Health plans. So whether it be your rate category or anything else, the 0 rate category is the average rate category or risk category within Advantage Health plans. So as you move to a +1, a +2, a +3, +4, you are a more risky bank as you move up that direction, and therefore you're going to be paying more in contributions. Likewise, the reverse of that, all the way down to a -5. For you math junkies out there, I'm just going to sprinkle this very quickly in here. I debated on whether to even talk this, but some people are going to want to know this. These categories, the labeling of 0 to +4 and 0 to -5, those are simply labels. The actual math behind that, again, everything is indexed. The middle rate category is actually, Milliman uses that, these are all relative values. They will index that 0 or that middle rate category to a 1.0. The overall variability between these rate categories, though, are the middle rate category of a 0 has a relative value of 1. The +4, the maximum rate category within Advantage, is a 1.30. Or 30% higher than the average. And on the other direction, the relative value of that -5 rate category is a 0.60. Again, for you math junkies, you can have fun with that. That dictates a lot of what Milliman does as far as working this out. I was not good in math, so if you're an HR person or a president that's not a math junkie, forget what I said, and we'll just stick to the 0s through +4 and the 0 through -5s. Okay, now as we break this down, what does your risk category mean to your bank? We've already talked a little bit about this. Your risk category indicates your bank's overall risk. It does not have to do necessarily with what you're paying or what your claims are. It has to do with Milliman's overall goal here is to determine risk. I'll move on and I'm going to pick up this thought on the next slide. But your bank's risk category is based upon multiple factors. These are really the things that our banks are evaluated upon. One of them, one of the biggies, is demographics. Demographics can be age, it can be gender, it can be the tier value, whether we've got a lot of single plans out there, we have a lot of single plus ones, we have a lot of families. Those are all in that demographics category. Also, in demographics is what's known as an area factor, and it is driven by your zip code. And this goes into Milliman's overall model, and they model every zip code in all 50 states as far as the relative healthfulness, that is a word, the healthfulness by zip code. Are you in a zip code area that has more health conditions than another zip code? They actually take that into account in their model. The next category that's used to determine your risk category are their morbidity score or the health score. Also, last but not least, is that claims ratio or loss ratio, basically the contributions in versus the claims that are being paid out, just that dollars in, dollars out calculation. Determining your risk category. This is where I was going to pick back up. Contrary to popular belief, your claims history accounts for a very small part. And when I say claims history, that is going to be that loss ratio. For years and years and years, when we went out to a bank, one of the first things the bank wanted to know, if they wanted to know how they were doing, was, hey, what's my loss ratio? And since Advantage Health Plans is essentially just a large checking account, dollars in, dollars out, and what is the balance, that was always a pretty important piece for us to look at. However, Milliman's small group model teaches us, they are the experts, that, and I think there is a lot of credence to this, that loss ratio, just pure dollars in, pure dollars out, is not a good indicator of the overall health in small groups. That was a little bit of a head scratcher for us, but we do strongly believe that they are correct on that. As the group size gets smaller, the volatility goes up, where you can have, we see it all the time, where we have a case that has 78% loss ratio 1 year, and then they have a 400% loss ratio the next year. And you draw a line through that, and it's just, for calendar year renewals that we deal with, it's just not a real meaningful data point. So we'll talk a little bit more about how loss ratio does factor, but it is a very, very small piece. The big thing, though, that we need to be aware of is that morbidity score. It can be up to 50% of your overall rate categorization. The morbidity score takes into account health conditions, procedures, and prescription drugs. Those are all assigned a point value according to their risk and their potential cost. On a monthly basis, we are sending Milliman de-identified, but of course they are within the protected health information, health plan operations, so they do kind of know everything that we know, with privacy being the utmost priority. But they do know what diagnoses are within your group. And those come from the doctor's bills and the hospital bills. What are the diagnoses? What are the procedures that our employees are receiving? What prescription drugs are our employees utilizing? What prescription drugs are being utilized with a given diagnosis code? Those are all things that we send to Milliman that they build into their engine to help with that, to figure that morbidity score. High dollar drugs, as an example, they equal higher more negatively, I guess, in your morbidity score. High dollar drugs are going to indicate a more risky situation. Also, compliance with medical advice. This is something that, I hope you all are understanding. This is such a deeper look than we ever used to do in the past. It goes so far beyond just dollars in, dollars out. But compliance with medical advice. For instance, if you've got somebody with type 2 diabetes, but we only see that you're going to the doctor maybe once every 2 or 3 years, that's going to get a higher morbidity score, as opposed to somebody that's seeing their physician on a more regular basis and are being more monitored. If we see that somebody is taking high blood pressure meds, however, the meds are changing every couple of months, the dosage is changing, the actual prescription for the blood pressure meds are changing, they're going to the doctor on a fairly regular basis, that indicates higher risk, because that would indicate that blood pressure is not controlled. On the other hand, if you have somebody that has high blood pressure, but maybe sees their doctor once or twice a year and they're on the same dosage and the same blood pressure med for the last 5 years, that is more indicative of somebody that has high blood pressure, yet is being controlled by medication and through medical evaluation. So that individual would put less pressure on that morbidity score. Shock type claims have little or no effect on your bank's overall risk analysis. And that's important to point out. If somebody has a car accident, if somebody was to have an accident where they broke a bone, were injured in some way, or somebody's on vacation and they come down with severe appendicitis, and they have a $50,000 bill to remove that hot appendix, that is really kind of a one and done, more of an acute type of claim that Milliman really doesn't even take a second glance at that. If it's a bolt out of the blue, it comes on hard, costs the plan money, but you can see that it was resolved, and most likely you're never going to see it again. It really doesn't move Milliman's needle one way or the other. Determining your risk category. We already said that morbidity goes for about 50%. The next that accounts for most banks, about 50%, 50% of their individual risk category evaluation is going to be demographics. I already talked a little bit about that, but it is things that are taken into account on that are age, gender, coverage tier / relationship type of each member. A lot of times they look at single versus family quite a bit, and Milliman is a global company. They do this work for insurance companies, all the people that I told you, but also a lot of insurance departments in various states across the country. They also utilize Milliman's model to determine whether an insurance company is using rational techniques for approving rates out there. So we do put a lot of credence into this methodology. But they do, as an example, a bank that has a high percentage of single-only coverage, it can have a negative impact on your demographic score. If your bank has a high percentage of family coverage, that can have a more positive effect on your demographic score. As we've been told and it's been explained to us, more single individuals are going to indicate that you've got either older folks out there, or potentially you're going to have just people where it's a single individual that is buying the coverage. If you have a family coverage, theoretically, you're going to have more people that are paying in. The premium is going to be a little bit higher, but on the most part, you're going to have less catastrophic type claims. Again, that's one of those things that is in Milliman's model. They have shown to us that it works. I cannot give you the exact science behind that. That's something that Milliman says it is a great indicator, and so we use it. Also, an area factor, zip code of each member. I already talked about that. See where I'm at on time. Looks like I'm doing okay. The other piece, which we talked about, which was that loss ratio. As we know, for determining the overall trust level increase, you could almost look at it that all that's used to determine the overall trust increase is the loss ratio of Advantage as a whole. But when it comes to an individual bank, loss ratio is a very, very small piece. Again, loss ratio can account for 0% of your risk category up to 75% of your risk category. The great majority of our member banks, loss ratio counts for nothing. I'll read here, depending on your group size, your claims can count for as little as 0% of your risk assessment. And that would be just simply that dollars in, dollars out factor there. If you're under 25 employees on the plan, it accounts for nothing. It's not even looked at. If you are over 25 but under 100, it can account up to 10%. So it kind of graduates up as it gets to 10% of your loss claims loss ratio can account towards that your overall risk category. If you're over 100 employees, it ranges from roughly 10% to a weight of up to 75%. We have very few banks that have over 100 employees on the plan. If you are one of those banks, you know who you are. But as that group gets larger and larger, loss ratio becomes a better indicator of the overall healthfulness of that particular institution. Again, if you were one, and again, we don't have any, but if you were one of those, the ultimate in this small group model, in small groups to Milliman or an insurance company, that's going to be up to like 5,000 lives. Below that, it's really considered small or mid-market for most insurance companies. But the maximum under this model for the largest bank, which we don't have any, would be the loss ratio would account for 75%, 12.5 for demographics, 12.5 for morbidity. But that's kind of something that you can take back to your bank to really help you all understand how this is being calculated. But I can't emphasize enough that a big piece of your overall rate increase or decrease, for that matter, is driven by the overall trust level increase. So I hope everybody's kind of seen how that fits together when we go back to, if you'll review your notes, go back to step one. That is a big piece of that. And so indirectly, loss ratio is taken into account for that overall trust level increase. It's just when we start talking about moving your individual bank into a more risky or a less risky rate category, loss ratio is not looked at as heavily or not at all. Okay. Risk category quick FAQs. This is just really kind of a at a glance overview. Points we want you to take back and remember is no matter how good or bad a claims year you've had, your bank can only move one risk category per year. Your bank is only moved up or down a risk category only if Milliman's model indicates that your bank should move two or more risk categories. That's again, that's kind of like a control rod put into a nuclear reactor to slow down that reaction, to slow down that volatility. It works for the bank and against the bank. It just slows it. But if you are really improving your bank very quickly, very dramatically, and you're moving everything in the right direction, it by design will take a year, a few years for you to start really realizing that. But we had Lynn Kinder as one of the AHP trustees. He's one of those banks out there that has been consistently moving their rate category into the less risky and therefore lower cost categories. I think he's had a shift to a less risky category every year since we've been doing this. So, I mean, he's really getting over into that green area of the risk categories. We'll see if he can keep it up, but it is doable. And it's one of the reasons why we really wanted to have this particular webinar, because when we put into place, we know how we're being measured, we know what helps the trust overall, we know what can lower our costs. If we really work together for this, there is no reason why, we've talked about it before, since this is simply a checking account, dollars in, dollars out, If we have more dollars that come in than they go out, we don't have to have as large of a rate increase, or theoretically wouldn't have to have a rate increase at all. But that is going to be a joint effort. It's a lot more difficult than it sounds. You all realize that. But the other thing that we always have to take into consideration is healthcare inflation. In my 21 years of doing this, healthcare inflation has never been flat. It has never gone down. It is always a positive number. So I want our banks to kind of look at that as that's kind of a headwind, that everything that we do positively, we are running into a headwind of healthcare inflation. Your risk category is likely not based on your loss ratio. That is an important point that we need to understand. Also, you can lower your risk, your bank's risk by employing these Go for Green strategies that we've talked about at the users group meeting. Okay, this is really kind of a summary slide also, but we wanted to be sure that we hit this. How do I affect how much I pay? There are things that you can do. One of the most important things, and so many of our banks are doing this, we're getting so many more phone calls and much more interest in this, is talk to your employees about being owners of their plan. Just like we've said in our users group meeting, people take care of things that they have an ownership stake in. That's part of this education process. It's part of understanding that when you are more judicious on taking care of your body, buying better when it comes to purchasing healthcare, all of those items that save money to you, the individual, even when obviously if it saves the individual money, that's obvious, but also the dollars that are saved to your plan also inure to your benefit, because the cost of the coverage can stay flat. It doesn't have to go up as fast, or theoretically it can go down in cost. So I'd like to say that our employees are really responsible for not just their out-of-pocket and their deductible, but indirectly we're all responsible for the 20% that we as individuals are responsible for, but indirectly we're also responsible for the 80% that the insurance pays. I hate air quotes, but try to enforce a point here. So it really is important that we take ownership of the entire equation. Help them understand what self-funding is about. Again, Advantage Health Plans is self-funded. That dollar saved is your dollar. I already hit this, but by affecting the total claims for Advantage Health Plans, we can lower contributions for everyone. Again, if the dollars coming in are outweighing the dollars going out, don't have to have a rate increase, or the rate increase can be much less. And of course, the reverse is true as well. If we're paying out more money than we're bringing in, there is nowhere else to get those dollars. There is no deep pocket, as Maria really emphasized at the users group meeting. There is no deep pocket out there. Our individual member banks, we are our deep pocket. And number 3, please contact us here at the Kempton Group at Advantage Health Plans to help us assist you in creating a Go for Green strategic plan within your bank. To help encourage healthy behaviors in compliance with medical recommendations, encouraging the use of our Premier Provider Program, more of our green providers on the Healthcare Blue Book. We are having our final pre-rollout demo from the Healthcare Blue Book folks. It will happen next Monday. We're going to flesh it out and hopefully have it all nailed down to present to the Board of Trustees at their meeting on the 26th. Hopefully it'll do everything we hope it'll do, and the trustees will approve the implementation of that. And when that happens, we'll be rolling that out to our member banks definitely by the end of the year, where we can start using that tool to inform and educate our employees on what are the costs of the care in our area, and who are the more efficient providers. I think a lot of us will be surprised at who the more efficient providers are, and probably will be fairly surprised at who the less efficient providers are. But education is power, and that's what we're going to be doing with that. Also utilizing LabCard, One Call, the over-the-counter drug benefits, and also moving to lower-cost therapeutic alternatives on the prescription plan. Also exploring adding a wellness program. Several of our banks have implemented our new wellness program. It is also a stepped process. None of the things that we're talking about here are a snap your fingers, fix it overnight approach, but taking the right steps and putting, for instance, a wellness program in place to help encourage more healthy behaviors within your bank, it helps everybody. It helps the individual, it helps their family, it helps the bank, it helps Advantage Health Plans as a banker-owned program. With that, I think we're got about 20 minutes for questions. See if I can keep from breaking something or shutting us down, and open up the questions. And if it's a fairly in-depth question, or if it's something that's individual to your bank, please give us a call. Some of these things are going to be possibly a little bit more sensitive, depending on the question. It might be better served if we answer that face-to-face or over the telephone. But if it's more of a general question on how I went through this, please just let it rip, and we'll see if we can answer those. I've either done a really good job or you're so bewildered you don't even know where to start. I don't see any questions yet. I'll sit here and stare at you for another 30 seconds or so and see. Oh, we do have a question. Oh, I knew that somebody would ask this one right off the bat, and I wish I knew. It's what is the recommended Milliman increase? And I'm sure that that is asking the overall trust level increase. I don't have that number. We have not gotten the analysis back from Milliman. They have everything that they're going to look at other than October, since we're still in October. We will keep them updated up to when the meeting occurs. You know, this last month is not going to be weighted any differently than any other month out there. But honestly, if I had an indication, I'd give it to you, but I just don't. Next question. When will we know our 2013 rates for budgeting purposes? Let me address that because I think it is important. By the end of next Friday, a week from this Friday, that meeting usually gets over no later than about 2 o'clock. We will know the trust level adjustment. And you will be able to talk to your representative to find out what that trust level adjustment is. But once that occurs, that's when we then, Kempton, will start working with Milliman. And as much as we've tried, it is not a cut and dried, enter data into a system and it just comes right out. A lot of times Milliman is going to be continually asking questions. We're going to be asking questions of Milliman. But once that trust level increase is calculated, then we go to work very diligently, and it is a kind of an all-nighter for a couple of weeks, trying to make sure that the risk categories are being implemented correctly. There are some banks that are just right on the bubble of moving to a different category or staying put. That a lot of times we may even look at case management notes and diagnosis prognosis notes up to the minute to determine whether or not a morbidity score is worthy of maybe holding a bank where it is or moving it on to that other bank. We do look at those kind of things. The trustees have given the Kempton Group a one category administrative latitude, which has gotten me in trouble before, and we try to be extremely judicial when we look at that. Again, we try to look at it only if a bank is right on the bubble between one category and another, and we also have to bear in mind that if a bank is on that bubble and we try to give them the benefit of the doubt, we also have to know that it's kind of a zero-sum gain, and that is if a bank was supposed to move up a category, but because it was right on that razor's edge by 1/100th of a point or something, and we decide to leave them where they're at, that's just puts additional pressure. It's going to have to be made up by the other banks, and so it's something that we look at that very closely. So, answer your question. I think Megan, it was the 16th, 15th. The 15th of November was when we had all of that completed and the mailing went out. November 15th. We will try desperately to get it at that date or before, but we want to be so very, very careful when we start doing that, because once we do that mailing, if we've made an error or we've made a mistake, it's very hard. The banks, they run off and you all start making decisions on this stuff, which is what you're supposed to do, but I'd hate to ever have an error. Believe it or not, with these rate categories, Advantage Health Plans, we're dealing with over 900 different rates, especially when you start taking into account the COBRA rates and the 13 different plans. This is a pretty complicated exercise. Thank you so much for the compliment. So I didn't confuse everybody on the call, just most. No. Will this webinar with the video be available later for viewing? Absolutely. You can go to advantagehealthplans.com under resources and choose videos, and we will have that. Of course, this is going to have to be digitized and be prepared for streaming, and that usually takes probably a couple of days to get that done and get it uploaded, but it will be there. Also, the slides will be available as well. Okay, looks like the next question, the majority of our dollars go to claims. What percentage of premiums go to claims? Well, in the last year, it has been up in the 90% point of premiums going to claims. That is not necessarily a great thing, because if we're paying a majority, if it's up in that 90% range, that means we've had some claims. Some large claims. Overall, if you look at it, we should be we're about 87% or 87 cents of every dollar normally is going to go for claims. Of course, if claims are larger, a larger percentage goes towards claims because we're dipping into reserve. That happened a little bit earlier this year. Here at the end of the year, we've been gaining fund balance and reserve, so it's been a good thing. How it's all going to shake out, I'm not for sure. But normally, if somebody was to ask me, perfect world, what is the percentage? It's going to be about 87% is going to be used for claims, and the rest is going to go to fixed cost. Okay. All right. Can you go into a little more detail on how to use the Premier providers where treatment is not in our community? Please make a distinction between emergency and planned medical treatment, incentives such as travel, lodging, etc. Okay, very good. Yes, our Premier providers, we've had a lot of flyers that have been out that we've done our email blasts under our Did You Know series that comes to the HR people. We're trying to get more employees to voluntarily sign up to receive those, but we educate our employees on that. Also on our website, advantagehealthplans.com, if you click on the Premier Provider link, it'll go into that. But I think this particular individual wanted to talk about if the Premier Provider and the treatment that is available with a Premier Provider is not necessarily in your community. If you all will remember, our Premier Provider program was originally modeled after a medical tourism concept. Remember, we had talked about the idea a few years back, just exploratory, but sending employees off to Bangkok, Thailand to have a hip replaced. And we're not talking about that kind of travel. But we do, that still is the model. In other words, if you live in Tulsa and we do not have a premier provider in the area that can provide the treatment that you need, we do pay for travel expenses and lodging expenses at, say, in Oklahoma City or in Dallas or wherever you may be traveling to. And in our reasonable expenses, we do have a corporate rate at a couple of nice hotels that are in the area of the premier providers. But if you really get serious and you're a patient that is in need of a procedure, you already have it in mind, we really encourage you just to call us at Advantage Health Plans, and we can walk you through all of the details, because usually these are it's almost been a new role for us. It's almost like medical concierge type of service that we've been doing, and it's been hugely successful. Obviously, emergency treatment is probably not a good type of situation for a premier provider. We want you to go and get the best care at the closest place that you can find. There's no penalty for, for instance, we've never had the scenario of emergent care is never in network or out of network. You're never penalized for having emergency services that are outside of your network. Hope that answered that question. Next question, can we obtain information on our particular zip codes and the related rate and demographics info for it? That will probably be very difficult. I have had conversations with banks where they really want to not only raise the hood, but tear into the engine. Milliman, even though we do purchase the utilization of this model is proprietary and it is work product of Milliman. So I don't know that they would allow, if I can have access to it, I am totally fine with giving it to a bank. My guess, though, is we'll ask that question. If we can take a note for the folks that are here in the room, please take a note, see if we can find out any information from Milliman on that. But again, my guess is that may end up being proprietary work product of Milliman. Okay, next question. What were the total premiums paid in the last 12 months? I'm going to shoot from the hip here, but I think on our last annual summary, Megan is sign languaging to it, is 20. Now, it's, I believe it was 20, I want to say 23, 26 million is the total premiums. And when you say premiums, I'm assuming you're meaning self-funded contributions into Advantage Health Plans. It's going to be in the mid 20 million range. There is a summary annual report that is going out. If it didn't go out this week, it'll be going out very, very quickly, and it goes to every participating employee in the bank. Most employees just trash it. They don't know what in the heck it is, but it is something that is required by the Department of Labor for us to send out, and it does have that question to the penny is in that summary annual report. Okay, let's see if I can follow this here. Are the combined PPO access costs plus the Advantage Health Plans admin costs less than the maximum allowed under the new Affordable Care Law? Yeah, absolutely. I think that question pertains to the MLR, the medical loss ratio provisions in the Affordable Care Act. Yeah, that is at 80% it's for fully insured carriers. It doesn't apply to self-insured plans because it's kind of nonsensical. If you think about it, it really has to do with how much of the premium dollar is spent on claims and how much, in theory, when they put this out for the fully insured marketplace, they want to know how many dollars are used for participants and how much is used for to return on investment back to the carrier or to their stockholders. And they tried to make sure that it would never exceed 20% profit, if you will, in the operation of a fully insured health plan. Again, it doesn't apply to a self-funded plan like Advantage, but Advantage Health Plan has always been, I had just said on a previous question, that is in excess of 87%. So we are always well in excess, and there also would be an argument made that since there is no return or profit at all, that 100% of the dollars that are allocated are going towards benefits and healthcare operations, since there is no spillover return. But looking at it the way a carrier would look at it, yes, we're in excess of 85%, approaching 90%. And that's something that the trustees are very proud of, and they look at to make sure about that. Is there any consideration to have a contract with Mayo or Scott & White as a premier provider? Mayo is a center of excellence for many procedures, and I hope that you and your employees don't ever have to learn about that. But through our stop-loss carrier, and if you read your plan document when it talks about organ transplants and things, we do mention Centers of Excellence, the Centers of Excellence program. The Mayo Clinic, MD Anderson, Baylor, for that matter, are all Centers of Excellence, even though, for instance, Baylor is not part of our standard PPO network because of some pretty dramatic contractual differences. But when it comes to certain types of procedures that are extremely case managed, we are able to get a case rate under a Center of Excellence program that is done through our reinsurance carrier. And Mayo, I don't know about Scott White, but I know that Mayo and MD Anderson are in there. Different top tier facilities in the country are in our Center of Excellence program. But as far as a premier provider type of an agreement, those top tier hospitals out there and systems, and I don't mean to be negative or anything else, but they're just not, we're a little ahead of the game on that. They're just not real interested in having posted pricing that is out there for the general public to look at. It's just not in their model right now. As we're starting to see more and more providers, it is usually starting with the smaller, the doctors and the labs and the radiologists and the ambulatory physician-owned surgery centers, physician-owned hospitals for like Oklahoma Heart and Oklahoma City. Those are where we're really seeing that transparency and that premier provider type of initiatives are really starting to catch on. I really think that the biggest systems are probably going to be the last ones to adapt to that, which is a little discouraging because they do negotiate on case rate basis for transplants and things like that. But they're not transparent. In other words, we have to provide them with lots of medical data and clinical information as to what the patient is going to have, and then they put forth an offer, and it is a case-specific offer. It's a little bit of a different scenario, but we are looking at any and all providers out there to be able to do premier provider type arrangements with. And I think when we get Healthcare Blue Book online, I think it's going to really drive home to, even though we're a little bank program out here in the central part of America, we're seeing a lot of these transparency initiatives all over the country are really starting to snowball. I think we are going to see more and more opportunities to utilize providers that have a they're more interested in being transparent, and I think tools like Healthcare Blue Book are going to bring that about. Again, if somebody has a situation in their bank where they have a catastrophic type situation and they are considering utilizing one of those top tier facilities like a Mayo or an MD Anderson or a Scott White, I would just encourage you to please call Advantage Health Plan's Customer Service Department and we can talk more about that. we like to be as creative as we can when we're talking about those very large dollar type of claims. I think that's the end of the questions. My iPhone says that we're 1 minute away, so I don't know how I did it, but it looks like we're going to close this thing out on time, didn't go under or over. So I so appreciate you all taking the time out of your busy day to be participants on our webinar. And again, if you have any additional questions, please contact us here at AdvantedHealthPlans.com or just contact your rep. We really appreciate your business and your confidence in us, and I hope everybody has a great fourth quarter.